But first, let's talk about what we are seeing in terms of market action and some of the challenges with navigating this market. In our morning brief this morning, our editor, Sam Rowe, wrote about some challenges here in the market and in this rotation and sort of getting it right and timing it right, and the difficulties inherent in that. We've all been talking about this reopening trade as it's been going on, but it's trickier to get the timing of it right, especially as we see some sort of volatility on the way there. And Myles, even if you buy the premise that we're going to get a face-ripping rally or 8,000 on the S&P 500 in the next 10 years or 8 years or so, it matters how we get there, and it matters what you bet on the way there. And there were some interesting numbers that Sam cited in that morning brief in terms of who has benefited from this recent rally.
Yeah, and it's another way to dice up a prior morning brief we wrote, which was maybe 3-4 months ago. I think right when the let's call it the vaccine and election rally really got underway back in November, December, and it was stocks that had gone down the most were outperforming stocks that had gone down the least. This was my favorite one. Stocks that had the cheapest per share price were outperforming stocks that had more expensive per share price. Of course, the per share cost of a stock says nothing about the value of the business. It's just an arbitrary number. So I thought that was an interesting piece of data and something that Sam surfaced yesterday. And it comes to us from Charlie Bolello over at Compound Capital Advisors. He's looking at the best 25 performers in the S&P this year and the best 25 performers in the S&P 500 last year. On average, the best 25 performers from 2020 are down 3% so far this year. So down through the first month and first quarter now, or first 3 months and first quarter now of 2021. And the bottom 25 performers last year are up on average 32% this year. Now, you look at the names in these groups, not a huge surprise. Tesla at the top of last year's outperformers. It's down about 12% last year. Don't cry for Tesla shareholders. It was up 743% in 2020. Look at Carnival. Stock was down 57% last year, and now it's up 20% so far this year. Obviously, a 20% gain after a 57% decline last year is not only not making up, it's hardly making a dent, really, we should say, in your losses there. And needless to say, you need to go up more than 57% to recover all of those losses. But it continues to point to how we see the rotation work within the market. And we can call it a move to value over a move to growth. But I continue to think of this framework of it's a rotation to things that didn't work, into things that didn't work and away from things that did. And you can slice and dice that by style, by sector, by valuation, however you want to do it. But it does not take a CFA to look at this list and say travel stocks and energy stocks got clobbered when there was a global pandemic and those stocks are acting better. And then pretty much anything that was derivative of how you stay at home, how you entertain yourself, how you keep your own power on, how you work from home in a pandemic, that stuff has done a little bit less good as we move into year two here. So obviously exceptions, shades of gray, but I feel like those frames are still relevant. And I think another one, which I'm probably going to write about for tomorrow, is this idea of what is good for America might not be great for financial markets. I think we should all welcome a year where financial markets are more challenged because the growth that was priced in last year is realized, and then investors say, now what? So I think all these themes have worked their way through the market to some extent, to a large extent maybe, in the last few months, but it's not clear to me that this trend is necessarily over because it's still kind of underappreciated, Saz. We're still talking about funds being overweight, all the names that we know and love, all the banks, all the tech plays, and people aren't really rushing into the energy plays and the airlines just yet.
Yeah, Myles, I would say too, maybe we do, Julie just talked about, maybe we do see that face-ripping rally, under the premise that as economic data improves, and we had the ADP report out this morning, that was pretty good, likely to see maybe a 700,000 increase on the headline non-farm payrolls on Friday. But as this data improves, all these stocks should do well.
By the way, here's a data point that didn't improve. U.S. February pending home sales were down 10.6% month over month. The estimate was for a drop of 3%. So that's interesting there. And and goes hand in hand with some of the other sort of pause indicating data we've gotten on the housing market. You're smiling, Myles, as you sit in your new home.
Way to rain on the party, Julie. Way to rain on the party.
Sorry, I gave you away.
I would just say that is another example, though, of everything that worked in 2020, which was, single family residential homes, maybe not working quite as well. We've all seen the charts of inventory. I mean, you can't buy a house. There are no homes for sale, basically, in most of the major metros. And so, again, I think part of the same theme, if maybe sliced a different way.
Interesting stuff. All right.